Hello, ladies and gentlemen. Tomorrow we've got ourselves a packed day of macro data. And the following day, we even have more. We're going to talk about what the market expects to see take place as far as risk. We're going to go over into some indices and really see what we see happening in the SPY, the Qs, the IWM, and some interesting charts here that have to do with the yield curve. All that and more on today's Stock Market Brief show, where we navigate the financial markets through the lens of technical and intermarket analysis. Let's go ahead and get into it. All right, people, welcome back. First and foremost, make sure that if you want this chart deck, I give the chart decks and you can download them for free right there in the pinned comment. You'll also see a pinned comment to my swing trading community. I don't post on Patreon, but they handle all the banking stuff for me. I post on the Discord, and once you sign up through Patreon, there's a guest post there that shows you exactly how to sync Discord up so you can get access to the trade ideas, watch list, expected moves, which I'm going to be sharing with you today, the Tradie Ticks bot suite, which is a whole bunch of good stuff, including the query where you can type in a bunch of commands to get various different areas of research. And then you have obviously access to the community there too as well, a whopping $9 a month, or you can pay annually. And it ends up being like $7 a month, where you just pay a one-time fee of like $90 US. It's not an alert service by any means. I'm not here to, say when to get in, when to get out. I just provide more research is all what I do there, okay? We're going to get right into it today and talk about what happened today. And what happened today was absolutely nothing. It was pretty much unchanged on the day, but we did finish around the highs in various of these index products. If you take a look at the 11 sectors that make up the SP 500, we had tech up there and XLY up there, which really risk on type of day. Towards the bottom of the list, you can see consumer staples, which is more of a risk off. And then you have energy that was hit too alongside of oil. Okay. Now it was a rather, calm day, because when we go into macro data reports, the day before can get pretty calm. Now there's also an important gamma level, which we'll point out, where price kind of got pinned around, and we have a, option expiration. So it may be hung up around those levels, seen as if inflation kind of comes in, as expected. If it doesn't come in, under like by a lot or over by a lot, we'll probably be hanging around the 4,800 strike on the SPX. Now, I know that might sound confusing to some, and that might make total sense to some, but if you stick around and subscribe to the channel and you continue to watch, we'll get into more detail where we can make it a little bit more easier for you to understand. But yes, core inflation is going to be coming out 1 hour before the stock market opens, and I'll kind of give you an idea of like if you do trade that, first and foremost, if you trade into it, right, that's a binary event. Even if they give us the report, to some extent, like you still don't know what the market's going to do and how it's going to respond, and what position to take. It's really important to let the market digest. Okay, so that is where when the report's coming off. We also have Fed speak, barking coming out, and then tomorrow on Friday we have the PPI data, and we also have Kashkari coming out to talk as well. And now it's important to know when the various Fed heads speak. Like today we had Williams come out, and Williams said this quote where I expect that we will need to maintain a restrictive stance of policy for some time to fully achieve our goals, and it will only be appropriate to dial back the degree of policy restraint when we are confident that inflation is moving toward the 2% on a sustained basis. So the Fed is right now kind of hawkish, and which that means it could be potentially, more bearish to the markets. And when they're dovish, it can be potentially more, bullish to the markets, I guess would be an easy way to say that. So not only do we have that, but we also have Friday, we have a lot of different earnings beginning to report. We start with the financials, right? So JPM is going to be reporting, UNH, United Health Group, sorry, that's not a financial, that's a healthcare name. We have Delta, Bank of America, Wells Fargo, BlackRock, Citi, BNY, and these are some large market cap names that will be reporting and be important to watch. Okay, now going into tomorrow, you can see the daily expected moves right here. So the SPX, right, $32 daily expected move. That's plus or minus. If you think of it in terms of a distribution curve, 68% of the time it finishes within that range of risk. Basically, how this is done, it's calculated, an averaging formula amongst various strikes for that expiry. And we get our levels, okay? You get your upper level, you get your lower level, and I even include 2 sigma levels. The 2 sigma levels, upper and lower, if you think of it once again in terms of a standard distribution curve, right? 68% of the time it finishes within this risk range. And if you go out to a 2 sigma, it's 94% of the time or so finishes within these ranges. Now you can see here why it's so important to understand implied volatility. This is implied volatility will give you more information than most earnings reports, right? Like you can go up against it's overcrowded area where people do and study the fundamentals, but implied volatility is incredibly important because it gives you insight to risk. All right. And you can just see here, if like going back a couple of days, these are the daily expected moves that I post, what this was for today and this was for the prior day. And you'll see here, the SPX, just we'll focus on that. It's, 21, going into today, it was supposed to be plus or minus 21. And daily expected move for the prior day was around 21.64. So you can see as the market's pulling into these reports, look at the implied volatility now, it's 32. So it's swelling up. It's telling us, hey, there's going to be more volatility, more potential risk going into, obviously, this trading session. Now, if we take a look at the Fed curve, why it's also important to really watch the CPIs, see what may change out here in March and forward, because if it comes in a lot hotter than expected or under expected or even at expectations, what is the market doing? The Fed fund futures, how are they pricing that into the overall market? And as it stands right now, we have pricing in the 1, 2, 3, 4, 5, 6 rate cuts. And that's coming off the back of a statement of Williams basically saying, no, we're going to be holding it here for higher for longer. Okay, so there seems to be some sort of conflict, and that conflict could lead to swelling of implied volatilities and obviously more volatility in the overall markets, okay? So we'll continue to watch this and see, hey, going into March, there's about a 65% probability, actually a little bit more, 66, 67% probability that the Fed will be cutting by 25 basis points. So we'll see here if that actually shifts and changes after the report, or if it really cements in that we will be getting that rate cut. Now, let's take a look at the yield curve. The yield curve is up here. This is the 10-year minus 2-year. You can look at the 10-year minus 3-month, but I like to show this one in relation to the S&P 500 since the time it has been inverted. And this is just something interesting that I found, that when it inverts deeper, the S&P 500 began to rally. When it inverted deeper, the market began to rally. It inverted deeper, the market rallied. Over here, it inverted deeper, which is, we haven't seen this since the 80s, and the market rallied even further. Okay, it wasn't, and then take a look here, what happens when the yield curve uninverts. This is important. When the yield curve uninverts, what happened? Well, we started to go down. We actually had a correction in the S&P 500. Then the yield curve started to go once again down into a deeper period of inversion, and the market set off like a rocket ship there starting in November. Now, what do we have going on really right here? Well, the yield curve is now minus 33 basis points inverted, and it's been going up really since, the beginning or the middle of December to the beginning of the year. It's actually at a new high for 2024. And you can see what's the stock market doing. The stock market really is actually just going sideways right now. It's consolidating. So if this yield curve wants to drop back down to a deeper inversion, perhaps it gives us more juice in the tank for the S&P 500. But what happens if we start spiking through and getting uninverted? Well, you got to follow along or look at previous videos where we showed various charts of when the market gets uninverted, when the Fed actually does cut rates. It hasn't throughout history been a positive sign. However, once again, that's not to predict that anything's going to happen. It's to prepare us and be aware if something were to happen, we're not caught off guard. And that's, I think, the most important part in all of this. If we take a look at the summation index, you can see the parabolic star ticked over 4 trading days ago. And what has the market done since that point? The market has done absolutely nilch, nothing. It's been consolidating. So when we do this, we say it's a potential change in trend or a period of consolidation. And you can see here, well, that is exactly what's happening. Now, the Nasdaq McClellan oscillator is still below 0 too, which is a little concerning that we have this below 0. And on top of that, we have this that's curling over, running into some bigger reports, which obviously can jolt things in whatever type of way. But it's just something to be aware of, that we still have the potential change in trend taking place right there. Now, if we go into last month's CPI report, I wanted to show you. So it's an hour before the market opens up. So this is looking at ES and on the 10-minute time frame. And this is why I say, be very careful trading into it. So if you were right here and you were long, you're like, yes, snap back down, okay? Or if you were short, it snapped you out and you're like, no, get out. And then all of a sudden it went down, all right? It's important to digest. So what can you do? You can anchor a VWAP right to that candle, the 1 minute. I couldn't go back on like the 1 minute, 2 minute, 3 minute, or whatever. I could only view it this far back on the 10 minute and higher. But if you anchor a VWAP to it, that right there is, high volume event. So it lets you know where the average buyer is based off of volume on that event, if they're above water or under water. And you can see here, we went down and this thing was kind of circling down. The market opened up at 6:30. We saw a stronger push to the downside. And then you anchor a VWAP to the daily, which is also quite important to do too as well. And you can see as price got above the daily, we started pushing up higher. And it wasn't until this portion, which is, a trade that I call the U-turn. The U-turn is where you see price kind of break down through, a key anchored VWAP or even like a swing high anchored VWAP, and it U-turns back up through it, and you really just wait for price to confirm. And you can see, so when we got back above that, then it's telling us that the average person that bought from this point based off of volume in that time is now in the green. And in that case, things get a little bit more bullish. Sentiment could potentially change. It doesn't necessarily mean that, but it can potentially change. And well, here, what did we see? Well, the market chopped around for quite some time, and then we started to break ourselves higher and close roughly at the high of the trading day. Okay, so that's one tactic, right? One tactic to help you really kind of get a clear picture going into an earlier session of trading, if you want to, if that's your thing. Okay. Now, if we take a look at gamma exposure levels, we've been having this 4,800 call wall. So it makes sense to me that we kind of floated up into this going into a CPI report. And then also we have OPEX and option expirations on Friday. So I can see that this gets pinned and kind of bounces around within this area. That would make a lot of sense to me if the CPI report comes in kind of around expectations. Now, if it comes in way under or way over, or it's an unexpected report, we can see obviously a stronger move to the downside and or a stronger move to the upside. So going into tomorrow, local support is around 4780. Local resistance is that gamma exposure level right there at 4,800. The gamma flip line is at 4,730, and this lets us know that dealers look to buy the dips, sell the rips, buy the dips, sell the rips, buy the dips, sell the rips, and so forth. When we get below there, the dealer positioning typically changes when we really, not at that level, but when we break from it. You get selling into selling, you get buying into buying, and you get a lot more volatility. Above these levels, we have 4,900 starting to kind of grow up there as the next call wall, which is, far away, but it's something to at least kind of monitor as time progresses forward. You can see we are trading outside of the weekly expected move. Remember, if you think of it in terms of distribution curve, 68% of the time, and with the SPX being as large of a product that as it is, the percentage is actually typically more. It's more north of 80% of the time it finishes within these. So that leaves for 20% of the time it can stand out. Or if you just think of the 68, it's still a decent percentage that it can close out underneath it. Now, the reason why these levels are so important is because this is where dealers, are safe. This is the okay zone. It's when you start breaking from these levels. Okay, these aren't support, they aren't resistance lines, although they can potentially act like it and seem to act like it. But this is just safe zone. So if we start really kind of breaking further from here, we can really start to squeeze, and you'll notice it on the smaller time frames. You'll look at the volume, like on ES, and the volume will just explode on like a 1 minute time frame. You'll see a very large movement in volume. Okay. But right now, like, our dealers tripping being, a few points outside of it, I don't think so, but I think we're not too far from the level to really make them start changing, to start dynamic hedging, buying into that buying and so forth. If we continue on and we look at the SPY on the 15-minute time frame, the last video we talked about was this. It was on this move, and we said, don't chase it. Now, I confused some people because I wrote, I missed the big move, what to basically do now. I should have put that in quotes because we were preparing for this bounce for actually a couple of days. It was more for people that, hey, if you miss this move, what do you do? And that's kind of why I titled it that. But we talked about the anchored VWAP from here and the anchored VWAP from here, and it kind of came up into this area like that. And we said, watch for the pullback, and look where it pulled back to. It pulled back to that swing high anchored VWAP almost pristinely, and we started to bounce and flag and then moved a little bit higher today. Okay. Now, as time is currently standing, the 5-day moving average is starting to incline. So the more time that we stay above it, it is inclining. We are getting a little stretched from it, but that's okay. But if you look back to the left of the screen, it is still kind of just going sideways, but it's positive that we are in positive gamma territory, and it is positive, check, check, that we're above a rising now 5-day moving average. And on top of that, we're above the year-to-date anchored VWAP, right? You can see it held as resistance, 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 and we finally got through to that level. And we're basically saying this whole pullback here, the average buyer now is in the green since this point over here. So all this level of confluence here can act as a potential level of support as time progresses. I would have liked to see the price action do a little bit more consolidation, but you never know. We still might see that. Okay. So as it stands now, a couple bullish things in our line of sight, except you want to see obviously it hold above these key levels, and you want to see it consolidate and get ready for its next move. Okay. If we take a look at the Qs, very same situation. You had that anchor VWAP here, the anchor VWAP low. We went over the Mag 7 stocks, Magnificent 7, and we pulled back into it. Okay, that was where we were getting prepared. And we said, hey, you don't just buy the weakness, but you look for the strength after. Boom, and we started moving higher. We consolidated and we pushed a little bit higher from those levels. The 5-day moving average is starting to turn up, and the year-to-date anchor VWAP is also starting to turn up. So that's a good sign at this current moment. Okay, things can change. Now, IWM has not been doing so hot. So if we're going to need more participation, I'd be paying attention to the IWM. Why? Well, because there's been multiple times where if the IWM diverges from the broader markets or from the SP 500 or even the Dow Jones, it's been a good indication of a potential change in momentum for those various indexes. So as the IWM has been going down, right, that could tell us that this move higher, is being driven by less and less names, and it could potentially reverse on itself. However, if the IWM catches up, that could be a positive sign. So we got to map out key levels. The year-to-date anchored VWAP, this is the index that is actually underneath it. Okay, and then the 5-day moving average, it is starting to flatten out as price action has been kind of just going sideways. Okay, chopping, boom, 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 boom. So this could be potentially an accumulation portion. Potentially, it could be a bear flag, but it could be potentially accumulation. All right, so how do you play that? Because that's important. Now, first and foremost, if you don't know, there's 4 stages to, and this gets fractal. It can be on any time frame, in any stock, any asset. There's 4 different stages that the stock goes through. It's accumulation, it's markup phase, it's distribution, and it's a decline, and then back to the accumulation phase. And what you'll see here is we went through a period of incline, right? Markup, distribution, this started declining, okay, that's stage 4, and now potentially this is starting to flatten out where it could be accumulation. Could be, okay? So what do? Well, we want it to hold above the 5-day moving average, and it would be nice to see it back above that year-to-date anchored VWAP. So if you start breaking above this kind of area here, that can send us up to go test the anchored VWAP from this prior swing high. However, if we break down from this low or potentially even this low, well, be more cautious, because that means that we're below the year-to-date anchor VWAP, below a 5-day moving average, and it will start to turn back down, and the decline phase could very well continue. Okay. When I look at this, I see a low and a higher low, and then as it stands, like roughly a higher low here, but I'd focus more on this one. Okay, so that's a positive sign, but also I'm seeing a lower high, and a lower high. So markets, they move between expansion and contraction. So what we're getting here is a period of contraction, meaning that most likely if we break down from this level or we break above here, we can see an expansionary move to the upside or even some more follow through to the downside. We like these type of moves where they contract because it gives us better risk to reward if we catch a stronger move of expansion. Okay, that's all I got for you on today's episode, everybody. Hope it helps out. See you later.